Hello friends, welcome to Ecoholics YouTube channel. My name is Avinash and in this video I'll be discussing with you economics current affairs for 29th October 2024. I have selected three important articles. Based on those three articles I have created three questions for you to attempt. Okay, the first article speaks about Make in India's 10 years and what is the progress that we have made in the last 10 years. Second article, it speaks about the International Monetary Fund, IMF's latest outlook on global economic growth and inflation. And the third article speaks about the recent initiatives taken by Government of India to strengthen the PSUs, to make them more profitable, to make them more efficient. So these are three very important topics that I would like to discuss with you. Let us start with our discussion, right? So first article is about Make in India. Now this article has been written by the Chief Economic Advisor, right? Now this is a positive article and it will help you in developing a a positive side of the story, in the sense that how has Make in India been helpful. It is very easy to criticize Make in India. There are enough number of articles, there is enough number of negative opinion out there regarding Make in India, right? Which we have also discussed as a part of our discussion over here, right? But this is in general a positive article which will be very helpful for you to balance your narrative. Okay, so it has been, like I mentioned, 1 decade of Make in India. Just hold on for 1 second, guys. Yep. So we see that it has been 1 decade of Make in India. Okay, and let's understand first, okay, what's happening. So if you understand the criticism is that Make in India had a target that we want manufacturing sector to contribute 25% of India's GDP. Okay, and we have not been able to achieve that. That 25% of GDP contribution from the manufacturing sector has not arrived. Okay, so what is the defense that the Chief Economic Advisor is presenting? So the Chief Economic Advisor over here is saying that you have to focus upon both the numerator, that is manufacturing's contribution to GDP, as well as the overall GDP. So you have to focus on both the numerator as well as the denominator. The fact that the share has remained stagnant, right? Manufacturing share has remained stagnant in the GDP means that our GDP has been growing consistently over the last 10 years, 7 years, 8 years, whatever, right? And the fact that the share has remained constant by and large means that even manufacturing contribution has been increasing, but just as a percentage of GDP we were not able to outpace the growth of GDP. Because if you want manufacturing share of GDP to be 25%, be double of what it is, be 1.5 times of what it is today, then manufacturing share of GDP needs to grow much faster than the share of than GDP growth rate. We have not been able to achieve that. But does that mean that we have not been able to achieve any growth in manufacturing GDP? That's not true. That's what he's saying over here, right? That ratio can remain same. Numerator keeps growing steadily, denominator grows at the same rate or faster, right? So that doesn't mean that the numerator is stagnant. Again, I'm just reiterating that over here the Chief Economic Advisor is saying that manufacturing's contribution to GDP has increased, right? It's just that it has not increased faster than the GDP growth. That's what he's trying to say over here. So it's not as if that the sector is stagnant. It's not as if that the sector has gone behind. That's what he's saying, and I think that this point is well taken, right? That yes, even earlier, if let us say GDP was 100 and manufacturing share was 15, right? That means that manufacturing sector was contributing 15 rupees. If today the GDP is 200 and if the manufacturing sector share is 15%, that means that we are contributing 30 rupees to the GDP. That means that the share of manufacturing, right, has remained constant, but the contribution as such has gone up. So the growth is definitely there, is what the Chief Economic Advisor is saying, and this is a point which is well taken, right? The question that he asks is that what would have happened had Government of India not launched Make in India initiative? What would have been the outcome? Had the outcome been better, worse, etc., etc.? So that's the kind of discussion. So there's a lot of parts of this article that I will pick and choose from, right, to be able to give you some points which will be very helpful for you in your answers, in your answer writing, right? So the Chief Economic Advisor says that first of all, we have to understand that in the last 7 years, and we are looking at this period between, let us say, 2014 and 2021, we are looking at this 7-year period. Okay. So the chief economic advisor says that there are two shocks that the Indian economy witnessed during the 7-year period. One is the credit bust. What was the credit bust? That there was a huge rise in India's non-performing assets in the banking sector. Why was there a huge rise in the non-performing assets in the banking sector? Because of excess debt that we had taken, right? Because of over-optimistic assumptions that we had based that, borrowing on, right? And eventually in the post-2008 crisis world, global growth went out of the window. Indian exports were not able to perform as well as we had thought that they would be able to perform. As a result of which, what we saw is that there was a huge buildup of NPAs, non-performing assets. There was a huge stress on the corporate balance sheet. There was a huge stress on banks' balance sheet, and all of these things had to be cleaned up, right? So we spent a significant amount of time cleaning up the corporate balance sheets, cleaning up the bank's balance sheets, right? So this was the first major shock. And during this shock period and during the receding of this shock, obviously, investments would not be very high, right? I mean, you don't invest when your balance sheets are stressed. You don't lend money when your balance sheets are stressed. So that's what the defense is, that during this period, we saw a major shock in the form of trade bust, right? Another major shock that we are talking about, since we are talking about 31st March 2021, right? So that was probably the COVID-19 shock, right? So the idea is that looking at these major shocks over here and understanding that yes, we have been able to grow at whatever rate we have been able to grow, right? So that's not a bad growth at all. Now let's put some numbers over here, okay? Let's put some numbers. We'll be talking about CAGR for a very long period of time, that is the compounded annual growth rate. So we'll be looking at the CAGR of GFCF, that is gross fixed capital formation. GFCF is a fancy word for investment, right? So if you are investing in a factory, if you are investing in a production unit, we will call it GFCF. Let's just keep it at that, okay? So we will be looking at the CAGR of GFCF, okay? So if you look at the CAGR of GFCF for 7-year period between 2014 and 2021, so that is around 4.9% on current price basis, 3% on the constant price basis. If you look at the GFCF of private corporations, that how much has the private sector been investing, what is the growth of private sector's investments, so you will see that the CAGR of private sector is 4.5% and 2.5% at current and constant prices, as per our chief economic advisor. Now this data has been taken from relevant sources from national income accounts of the MOSPI, right? Now, if you look at the CAGR, the 7-year CAGR for investment in machinery and equipment specifically, right? So then you will see, because see, investment can happen in a lot of things. Investments can happen in land, it can happen in building, it can happen in fixtures, it can happen in equipment, it can happen in machinery, right? We are most important, or we are most interested in machinery aspect. Why? Because if you have more machinery, if you have more equipment, that means that your production capacity is going up. Okay, so let us highlight some numbers related to CAGR for investment in machinery and equipment. So that is coming out at 3.5%, right? And that rate drops to 1.8% for private corporations. So how do you understand this? You understand this saying that had the PSUs and the government not been pushing investment, then our investments in the manufacturing sector, in the machineries, in the equipment would have been far lower than what it is today. This is how I am able to interpret it, right? If you get any other interpretation, or if you have any other interpretation, please feel free to share your opinion, right? So the idea that we need to keep in mind over here is that we have looked at this particular 7-year period. This is a period of credit bust that we spoke about. This is also the period of COVID pandemic that emerged. Apart from the two shocks, there were structural reforms that we launched during this period. One is GST, that is goods and services tax, and the other is insolvency and bankruptcy code, right? So during this period where we are having two shocks and two reforms, still we are managing to grow at this number of 4.9%, 3%, 4.5%, 2.5%, right? So I'm sure that the chief economic advisor is trying to make you believe that these numbers are not bad numbers, right? If you look at the numbers post-COVID, right? If you look at the numbers post-COVID, so if you look at the CAGR of GFCF, so the number increases considerably, right? It becomes 26% and 13%, right? So significant investment activity has taken place post-COVID is what is happening over here. If you look at the private corporations ka GFCF in the post-COVID period, right? So these numbers are very healthy, right? Around 23% and 10%, right? And if you look at the CAGR of GFCF in machinery and equipment, right? So that number is 28% for the overall sector, 29%, and around 30% for the private sector, right? So basically, if you look at the situation post-COVID, it has considerably improved, right? So the interpretation that is getting drawn, at least the way I am interpreting this, is that there is a credit bust. We take care of it. We implement the GST, which is in itself a traumatic process because of the teething issues, right? Apart from that, we also launched the insolvency and bankruptcy code. Just as we are at the takeoff stage, we have COVID-19 pandemic, right? And after the COVID-19 pandemic has receded and we have been able to take care of that problem, we have this launch of a decent growth rate ka phase. This is how the interpretation is coming out to me, at least based on the way numbers have been stacked up, with the based on the way the narrative has been stacked up, right? So a lot more data can be thrown at you, right? But I don't think that that is going to be relevant. So I'm going to hop, skip, and jump and very selectively discuss what needs to be discussed over here, right? Now let's just come to some relevant numbers. Okay, everything can be relevant, but from my point of view. So if you look at this period over here, and if you look at the average number of workers in factories, right? So average number of workers in factories that has increased from 249 to 262. So if you look at the universe of factories where there are at least 100 workers, right? So average number of workers in such factories has increased from 249 to 262. If you look at the average number of women workers, okay, this number was for women workers. This number, this article has some issue over here, okay. And if you look at the average number of employees, right? If you look at the average number of employees, right, where there are 100 employees and more, right? So average number of employees has gone up from 313 to 327. So workers is probably those who are working on the shop floor, right? Employees means those who are working on the shop floor plus administrative employees, right? That's how I am interpreting this, right? So this is the number. So this shows that the size of our employment force in factories has gone up. Number of people working in each individual factory has gone up. If you look at the total number of companies, so between 2016 and 2024, the number has gone up from, let's say, around 9,80,000 to around 16,30,000. Okay, number has gone up in manufacturing also. Number has gone up in the entire universe also, right? They have also shared some numbers related to paid up capitals and so on and so forth, right? Now the point over here is that कुल मिला के बात क्या है? What is the ultimate conclusion that the chief economic advisor is driving at, right? So he is saying that we need a tripartite conversation between A, the union government, B, the state government, and C, the private sector, so that we can take further the process of reforms so far as deregulation is concerned, so far as usage of technology is concerned, because we are otherwise a labor surplus country. So how much capital do we want to deploy? What kind of machinery do we want to deploy? So there needs to be a consensus and a conversation around that topic for us to be able to drive at some particular conclusion and move ahead, right? And we also need to look at what's happening to the labor share of income, because whatever profit a company is generating, that profit will get divided in amongst factors of production. There are two chief factors of production, which is capital and labor. So how much income is going towards the owners of capital, how much income is going towards the providers of labor? That is something that we need to look at, and we need to ensure that this number is healthy. We need to ensure that this number is healthy. Only then will the problem of inequality in India decrease. Only then will the problem of poverty in India will decrease. Only then the standard of living in India will increase, right? So the idea over here is that these are good suggestions that the economic advisor is providing to you, which you can easily incorporate in your answers as suggestions, as way forwards, that we need to have these conversations around these topics, right? So deregulation, already a lot has been done, lot more can be done. We need political stability and continuity, right? And there has to be a lot of discussion that how we can boost employment, right? And so on. Apart from this, entrepreneurs and industrialists, even they have a choice to make, that how ambitious they want to be, how fast they want to grow, how big they want to grow, because ultimately it is their choice that will determine the direction of the future growth. Okay, so this is the article. some relevant points regarding what has been achieved so far as Make in India is concerned, right? So that you will be able to make a balanced narrative when you write an answer on this, right? So you have to talk about the shocks, you have to talk about the reforms, you have to talk about the sector's growth nevertheless, and you have to admit that yes, there is more that can be done and some suggestions going forward, right? So from one article, this is the best that we can extract, right? I hope that you are appreciating the content that we are providing to you. This content can be downloaded from Ecoholics app. You can just download the app, do the registration, etc. Free of cost, and download the material, right? Moving ahead to the next question. So next, I would first like to discuss the PSU article, because I feel that that is more important a topic, right? We have not discussed it that often, and I believe that there is a significant scope for this topic getting asked in the examination as well, right? Now, see, you have to understand why were the PSUs set up, okay? So PSUs were set up, so PSUs were given scarce capital of the country, right? PSUs were set up to occupy the commanding heights of the economy in terms of bringing about industrialization. PSUs were set up so that when it came to core industries or basic industries or heavy industries, we could establish some kind of self-reliance, right? But more important than anything else, PSUs were also set up to generate profit. That profit would be let us say shared with the owner, that is Government of India, who could then use this profit for their own purposes. So whether it is welfare or whether it is managing their capital expenditure or whatever, the idea was that PSUs were supposed to be healthy and profitable, right? So even while the PSUs were bringing about a development of the backward regions, even while the PSUs were generating employment, even while the PSUs were developing industrial townships and whatnot, even while the PSUs were the flag bearers of standard of employment, right, as to how you are supposed to treat your employees and so on, they were always expected to be profitable. It just so happened that when you were trying to chase so many different goals, and the fact that there are bureaucratic inefficiencies that are always there, so somewhere we lost focus on profitability, somewhere we lost focus on efficiency, and we have paid a heavy price for that, right? And we don't need to do this anymore. We need to correct our past mistakes, right? We need to chart a recovery, and that's what the present government is trying to do. That's what this article will help us in understanding, that how can we chart our way back towards profitability, towards efficiency, towards growth of these PSUs. Because हो गया, backward regions को जितना आगे ला सकते थे ले आया, employment create करवा रही है, industrial townships have been created, they have established standards of employment, etc. All that social services is done. Now let's talk about profit. मुद्दे की बात पे आते, right? So the idea over here is that we want these organizations to be efficient, professional, and profitable, right? We don't want to sell these organizations early. आज नहीं बेचना है, because if you try to sell a loss-making PSU today, you are not going to get a lot of value. But if you are able to convert this loss-making PSU today profitable over the medium to the long term, and then when you when you sell a small share of your ownership, then you will get a bigger bang for your buck. So it is absolutely correct to say that it makes zero sense to sell loss-making PSUs today. It makes 100% sense that let us turn around these PSUs on a mission mode into profitable PSUs. If we can have Jandhan accounts created overnight, if we can have this JAM Trinity created, if we can have UPIs and ULIs created, if we can have the successful rollout of the vaccination program the way we did, if we can have a turnaround of our defense PSUs the way we have done, if we can go for the Mars, go for the Venus, right, then I'm reasonably sure that, if you apply your mind, if you select certain PSUs and you set a target that in 5 years I want you to be profitable by hook or by crook, do what needs to be done, I appoint the best managers, I don't see how the results will not come. The results will come, right? So that's what the government is trying to say over here, that boss, we want a greater value out of you, right? We are your shareholders and we want you to be profitable, right? So let's strengthen the PSUs, right? Let's collect healthy dividends, right? Let's publicly list these PSUs and let's get good returns, not only for ourselves but for everybody, right? Most importantly, let's run them professionally, right? board driven decisions should be taken rather than ministry driven decisions to be taken. We don't want mandarins sitting in New Delhi to be deciding what happens within these PSUs. No, we want board driven decisions, right? Whether it's a strategic PSU, whether it's a non-strategic PSUs, because see, earlier 2 years ago, Government of India came out with this disinvestment policy, and they said that we will divide the entire universe of PSUs into two groups, that is strategic PSUs and non-strategic PSUs. And non-strategic PSUs के अंदर से we will do an immediate exit. That policy to me was looking very hasty. That policy to me was looking very ill-conceived. To be very honest with you guys, let's be a little honest with ourselves sometimes, right? Now what we are saying is that no, we don't want to be in a hurry, and if this is actually the policy which is going to be implemented, then that's good, right? So 2022 के अंदर Union Cabinet they approved empowering PSU boards. You can undertake full or partial stake sales. You can close any subsidiary. You can sell any joint venture. You will take your own decisions. That is PSU boards, right? Now, the point over here is that Government of India, they have decided to invest in the companies if they feel that that's required, right? And some entities that are doing better than others, right? They will be helped and everybody else will be motivated, right? अब जैसे for example, राष्ट्रीय इस्पात निगम Limited, they own 7.5 million ton capacity Vishakhapatnam steel plant in Andhra Pradesh. They will be getting a revival package, right? They will be getting a restructuring plan, right? So that this loss-making steel maker can become efficient and self-sustaining, right? Government had also approved strategic disinvestment of government stake in RINL in 2021, right? But वो आगे नहीं बढ़ा और आगे बढ़ेगा भी नहीं. कोई पैसा नहीं डालेगा. Nobody will invest in a loss-making PSU that is still very much a government company, because you will not be able to turn it around. When will I as a private guy invest money? When I know I can turn it around, when I know that I can reconfigure the plant the way I want to do it, whether it is manpower terms or machinery terms or technology terms or operational terms or any terms, right? So people will not put money into government companies till they do not have the belief that yes, this can be turned around. So, and honestly speaking, government can turn it around itself. That's what they are doing now. Okay. If you look at MTNL, right? So they have an outstanding debt of around 8,000 crore, right? So sovereign backed bonds are there to help this company out, right? So that's happening, and discussions are underway that how you can turn it around, right? Long tail of healthy CPSEs is what we want, which can give us better dividends. So if we have efficient PSEs, right? So we will be able to create more value for our stakeholders, right? We can create better dividends, okay? And we can launch them on the bourses eventually. So government, it earned around 60,000 crore PSU dividend in FY23. It increased to around 64,000 crore in FY24, right? So, so far we have already collected around 28,000 crore of dividends, right? And, you know, we are likely to collect more dividends going ahead, obviously, right? So this is a good way to go ahead. This is a progressive way to go ahead, right? Larger PSEs, they are profitable. Larger PSEs, they are adding value, right? To the government revenue with dividend, right? And if you are able to get this board driven professionalism, then that will be really, really helpful, right? And it will surely appeal to the market also. This is not me saying, this is Madan Sabnavis, and you know that we respect Madan Sabnavis a lot in this particular lecture series, right? So disinvestments, this has been a non-starter in India for some time now. We have not been able to do disinvestment, right? So we are only doing stake sales of minority shares, meaning 5%, 7%, etc. Thoda we are selling, or we are doing a follow-on public offer or an FPO, right? So hardly anything we have mopped up in terms of disinvestment receipts in this financial year, right? So the idea over here is that privatization plans are ongoing, right? But we are taking a calibrated approach. Rather, we are more focusing on value creation from disinvestments, dividends and returns for shareholders, meaning that they are justifying that why they are not able to undertake disinvestment. They are not able to undertake disinvestment maybe because they are not confident of fetching the desired value. And if you sell these companies at a cheap throwaway price, then you will be heavily criticized, not just by the unions and the leftists and the critics and academics, but you will be criticized by anybody and everybody who is having a rational mind that why are you selling family silver at such low prices when you can turn it around and sell it at a much better price. So it's just common business sense which is stopping the government dead in its tracks so far as disinvestment is concerned. That's how I am reading it, right? Apart from that, union budget, right? They have not kept targets for disinvestments because these targets are becoming embarrassing. you set a target of 1 lakh crore, end up achieving 20,000 crore, then there are a lot of questions that starts getting asked, right? So we have moved away from this practice of setting revenue targets for disinvestment or stake sales, right? We'll do it at our own pace, right? So successful CPSEs, they have improved their operations, they have improved their financials, right? And they have increased their market capitalization. So 18 CPSEs, they have yielded 51,000 crore, right, of money to the government, right? So yeah, I think that the article is done. You have gotten the point, right? You have gotten where the government is trying to go, right? Now we just need to kind of understand that how we need to go there. अब जैसे for example, there is this Navratna ka system of giving greater autonomy. So recently we gave Hindustan Aeronautics Limited the same Maharatna status that we have given to other companies, right? Apart from this, in August, your Railtel, Satluj, as well as National Hydro Corporation, Hydroelectric Power Corporation, and Solar Energy Corporation, they were upgrading to Navratna status. So there are 25 companies that have been given Navratna status, right? Apart from that, IREDA, that is Indian Renewable Energy Development Agency Limited, that was listed on the exchanges, that has also been given a Navratna status, right? So asset monetization plans, they are unlikely to change track. PSEs will be segregated. They will be sold off their land, their real estate assets that will be sold off, right? Because if you're sitting on surplus land, if you're sitting on surplus assets which you have no use of, that you can sell. So you can clearly see that there's a multi-pronged approach in play over here, right? Number one is what you do with the PSEs themselves, right? So PSEs we have clearly divided into a couple of categories. There are Maharatna PSEs, there are Navratna PSEs, and there are loss-making PSEs. Reform them, grow them, and these are our stars. Let's not disturb them, right? Give them greater autonomy, and give them greater professionalism. That is what we'll do with PSEs, whether they are strategic or non-strategic PSEs. Apart from that, PSEs have a lot of assets, right? Unused lands, buildings, and so on and so forth. Let us monetize this asset irrespective of whether it is belonging to this or this, because this asset is sitting dead for a very long period of time. Let us monetize this asset. Let us make some money out of this asset. No harm in that. And the individual boards can take the decisions as to which assets they would like to monetize, right? So this money will be very, very helpful not only for these companies but also for the parent, that is the government of India, right? So far this is the discussion. One thing that I would like to find out for you guys is that exactly what are the 10 steps that we should take, right? So that these PSEs become, humongously profitable. So that these PSEs become humongously profitable, right? That is what we need to discuss. What are the 10 steps? So in the meanwhile, this is a question that I've created for you, that analyze the recent shift in the government of India's approach towards managing PSUs by prioritizing efficiency and profitability over immediate disinvestment. Discuss the rationale behind this approach and its potential impact on shareholders, including the government. So it's a very leading question, right? In examination, you may not get such leading questions, but it's okay, right? Do practice answering this question, and it will be helpful only in your examination because the content will be ready. The nature of presentation may change a little depending upon the question, right? Now let us speak about what's happening to global inflation and to the global growth, right? So the idea over here is that global inflation, it has been tamed, and how do we unleash growth? That is the question that we are trying to ask ourselves, right? So IMF has said that the battle against inflation has largely been won, and they are speaking for the entire world as a economy. They are not speaking only about few countries, right? So that's what IMF is saying, right? So how will global economic growth respond, right? So let's see. Okay. So what is IMF saying? So IMF, they come out with this World Economic Outlook. This World Economic Outlook, if I'm not wrong, it's published twice in a year, right? So the growth prospects for the entire world, they have stabilized. So we will be growing at 3.2% in 2024, slightly lower than 3.3% that we grew in 2023, right? India will grow at 7%, right? US will grow at 2.8%. China will grow at 4.8%, right? China will not be able to meet its 5% ka growth ka target because of the challenges of the sluggishness that is there in the Chinese economy, right? Germany and France, they are also not going to grow as strongly as we were expecting them to grow earlier, right? So this is the broad outcome from IMF's World Economic Outlook so far as the growth prospect is concerned, right? So far as inflation is concerned, so it has peaked, right? So headline inflation rate, it has peaked at 9.4%, right? And it will decline towards 3.5% by the end of 2025. So the average inflation that we saw was 3.6% between 2000 and 2019. Going ahead, we will witness inflation lower than that is what IMF is predicting, right? So this reduction in inflation, right? So we have been able to achieve this without triggering a recession, because how do you bring about inflation reduction? By increasing the interest rate. And when you increase the interest rate, you tend to reduce demand. And when demand reduces, you tend to reduce the GDP growth rate. And if GDP growth rate slips into negative, that's recession for you. If it happens for 2 consecutive quarters, that is, right? The good thing is that we have been able to take care of the inflation aspect without triggering recession, as I just explained over here to you, right? So that essentially means that, you know, a lot of economies have been able to achieve smooth landing, in the sense that you have not crash landed, you have landed the way you should have landed, right? Is it an all and out and out rosy prospect? Not at all, right? So if you look at the medium term global growth, right? So that's still being pegged at 3.1%. That's not a very good number. It's not encouraging at all. So this number is low because of China, which is performing not so well. Latin American and European countries are also sluggish, right? There are structural headwinds across the world, such as demographic winter, meaning aging population, right? And weak productivity growth, right? What are the risks? So conflict, regional conflict is a risk. Protectionism can be a risk. Let Donald Trump get elected, and then you will see the fun unleashed on the entire world, right? Of course, anybody gets elected, that's absolutely not a problem, right? But Donald Trump seems to have a fair bit of inclination towards protectionism and making America great again. And if you want to make your country great again, and I want to make my country great again, then that's just beggar thy neighbor policy in different clothes, right? Apart from that, we are having deeper than expected slowdown in China, right? And there can be supply disruptions coming in from climate, health, and geopolitical reasons. If any of these things materializes, we don't know which particular peril or threat will materialize, but if any of these threats do materialize, then our future growth prospects may be hurt even more than what we are projecting. We are already projecting a 3.1% growth rate for the next 5 years. This number will come down going ahead if our threat predictions do actually materialize. What can be done? What are the policy prescriptions? So there's a triple pivot that they are suggesting. Nice word, triple pivot, right? Central banks, given that inflation is under control, they should reduce the interest rate and give a boost to economic activity, right? We should try to reduce debt, right, which has ballooned. Okay. So the government needs to do this. They need to pivot towards lower debt. They need to give greater space to the private sector to borrow if they lower the debt. And structural reforms to lift productivity and growth prospects, right? So triple pivot is what? One by the banks, one by the executive, and probably one by the legislature in terms of structural reform, right? So give a booster to technology and innovation, competition, resource allocation, economic integration, and productive private investment, right? So this is the triple pivot that you can also cite as, steps that India can take. These are very generic suggestions which can be made applicable whether it is Indian economy or the Indonesian economy. So the question that I am posing for you is that examine IMF's latest outlook on global economic growth and inflation, discuss the potential headwinds and risks for growth, and elaborate on policy recommendations to sustain economic stability in light of the challenges. So this is my discussion for you guys today. I hope you have learned a lot of new stuffs. I hope that you will be doing answer writing based on this. We'll be meeting tomorrow again. Until then, thank you so much. All the best, and Jai Hind to all of you.